Hello, everyone. This is Tim Leveroni. I want to thank everyone listening to this market update call. Our goal is to educate you on the current market environment and share perspectives for some of the investment managers we recommend. Shortly, I will introduce our speaker, Colin Allen. He will present LPL's financial outlook on the current markets. This call is being recorded today. There will be no questions during the call. If you have any questions, please call or email us. Colin is a member of LPL Financial Research Tactical Asset Allocation Committee and responsible for contributing to the development of the general market strategy with a focus on fixed income. Colin is a chartered financial analyst. He joined LPL Financial in 2010. Colin, you're up.
Well, thank you very much, Tim. It's my pleasure to be here to talk about our views on the global economy, stock and bond markets, and our outlook for the near future. So getting right into it, I think what underpins, from the highest level, our view that the economic expansion that we're in is likely to continue is the fact that global economic growth is poised to accelerate this year. And that's not just a domestic phenomenon, but global as well. So in the U.S., we're looking at a pickup in economic growth from 2017 levels, which were higher than 2016 levels. So we think that the growth we see in the latter half of 2018 may get up to the 2.75 to 3% gross domestic product GDP growth range when the kind of reverberations of the tax cuts finally make their way through the economy. Unemployment, we think, continues to trend lower as the economic expansion continues. And inflation in terms of the consumer price index year-over-year change of CPI, we think that remains pretty well contained around 2%. But looking out internationally for Europe and Japan, developed foreign markets, a bit behind us in terms of their recovery. So they're continuing to pick up steam as well. Emerging markets are too. We see growth rates moving higher there as well. Obviously, kind of a different nature of their economy in terms of manufacturing versus our service-driven economy, better demographics as well, leading to higher growth rates overall, which does make emerging markets one of our favorite places to invest internationally at this time. But all in all, I think the story here is that growth, across the globe is really trending higher, and that makes for a good global economic backdrop in which to invest. In investing, just like anything in life, there's virtuous and vicious cycles, and I think this is one of these virtuous cycles where strength begets strength, making for a good backdrop for the economic expansion to continue here. So turning now to stocks specifically, one of the most prominent things about markets so far in 2018 that clients are likely to be thinking is the market volatility that we've seen. And there, frankly, is good news and bad news associated with that. The good news is that this is normal, this volatility that we've been seeing. The bad news, however, is that normal doesn't always feel so good, as we're now finding out with the volatility that we've been seeing. I think the context here is important. And so when you look back and think about 2017, that really was the anomaly. Markets just kind of bled higher every month. All 12 months, the S&P 500 was up. That's never happened before. So it certainly is jarring when we have a market that was as kind of complacent and trending higher last year as we did to see this volatility thus far year to date. But this really is just markets being markets. This is kind of the normal level of volatility. And when you look back over the past 25 years, the average intra-year pullback for the S&P 500 is 14%. So if you think about, in the average calendar year from a high to a low, the average decline is 14%. That seems a little jarring, especially when you come off a kind of very calm, very good year like 2017. But we are transitioning more to a normalized business environment. And one of the unfortunate things about that is volatility. So we're transitioning from an economy that's been driven by monetary policy, that's the Federal Reserve holding interest rates very low, to one driven more by corporate fundamentals like earnings growth, which we'll discuss, and fiscal policy in the form of tax cuts, deregulation, or infrastructure spending. We've already seen tax cuts come through. We've seen a lot of deregulation by the Trump administration, and we may very well get infrastructure spending as well. So that's, as we go back to more of these kind of normalized cycle drivers, we will see volatility pick up because, frankly, that's a more normalized environment. for markets. And I think the other thing that's important to remember about volatility is that it's a very complex world. There's lots of risks, geopolitical risks and trade risks, which we'll discuss. But this volatility is really markets trying to make sense of it all. And so while it's unpleasant, it is a sign of a healthy, functioning market. And as kind of a research professional, when we look at something like 2017, that's almost more disconcerting to us, because as markets just move higher gradually and kind of in lockstep, that means that everyone kind of has the same views, and that is a situation in which everybody's kind of betting on the same things. And frankly, that's a situation where if things do go the opposite direction, the volatility could be even worse. So we think this is a sign of healthy markets, and frankly, the volatility, we believe, is here to stay. But given our views on the global economy, we do think that it will be a good year for stocks overall, and the reason for that is earnings growth. So earnings growth is really at the center of our belief that 2018 will be a good year for stocks. Corporations are making more money in earnings than they were last year, and it's atypical for stocks to do poorly given that backdrop. So just remember, for stocks to move higher, at least one of two things needs to happen. Companies need to make more in earnings, or investors need to be willing to pay more for each dollar worth of earnings. So you may hear about a PE ratio, which looks at valuations, right? The price divided by the earnings. So how much in terms of price are investors willing to pay for each unit of earnings? So we think that even if PE ratios stay the same in terms of the valuations of stocks, you could see a very good year for equities still because of this earnings growth. Companies are just making more money than they were last year. Again, that's not just a domestic story, that's global as well. So if you look at developed foreign, whether it's Europe or Japan or emerging markets, the earnings growth is there, and we think that's why 2018 will end up being a decent year for stocks when all is said and done at the end of the year. But certainly risks remain. There's geopolitical risks. There's lots of things that are hard to quantify and really hard to predict. But protectionist trade policy in the form of tariffs and eventually trade wars are certainly one risk that's been in the headline much recently. I think it's important to understand these things, and it's important to put them in context. And so, from a high level, trade wars basically result in nothing but losers. A select few industries may benefit, but the losses generally outweigh the gains, and prices generally move higher for consumers. And it usually has a lot of unintended downstream consequences, a lot of which were unforeseen. So, from a kind of economics 101 perspective, it's not generally good policy, but I think the headlines have spooked a lot of people, but the context for this is important. So if you look at the impact of fiscal policy that I've seen this year, that's tax cuts, spending by the government, and repatriation, letting companies bring back foreign profits at advantageous tax rates. If you add those all up, that's about $800 billion in estimated economic impact this year. And if you put all of the kind of tariff implications, the headwinds from tariffs, put those dollar impacts together, that adds up to about $36 billion. So again, the magnitude of the fiscal policy boost to the economy we'll see is, just far and away greater than anything we've seen in tariffs. It's important to note that the steel and aluminum tariffs are really the only thing that's become law. It still remains obviously a headline risk from our perspective, but something that at this point, the kind of bark is worse than the bite, if you will. So a risk that we're monitoring on an ongoing basis, but something that we think when put in context is not as big of an issue as it may be kind of portrayed out there in the media. Another phenomenon that we think is critical to the economy this year is rising interest rates. As I mentioned earlier, prior to this year, we had been in a regime dominated by monetary policy. And just to kind of give a quick overview of the Federal Reserve, every economic cycle since World War II has basically followed the same path. The economy goes into a recession. The Federal Reserve lowers interest rates in order to catalyze growth and stimulate spending and really force the economy to grow. It does. The economy pulls itself out of recession. And at some point, the Fed says, okay, the economy is well enough to stand on its own 2 feet. we're going to raise interest rates now in order to not let the economy get too hot, in order for inflation not to get out of control. Eventually they raise interest rates too much and the economy slowly goes back into a recession as well. And we've seen that pattern every economic expansion since World War II. The difference with the one we're in now currently is that it's been protracted, so it's been a very long expansion, but the Federal Reserve also used other tools in this expansion as well, and one of those was lowering short-term interest rates, which they did all the way down to near zero, but they also bought Treasury bonds in the open market, and what that did was essentially suppress long-term interest rates as well. And so the Federal Reserve is kind of trying to get out of both of these games, and the result of that is rising interest rates at the short and long end of the curve. So if you think about short-term interest rates, that might be what you're going to get in your bank deposits. If you think long-term interest rates, that might be kind of mortgage rates and things like that. And both kind of sides of those coins are moving higher. And it can be painful when interest rates rise because high-quality bond prices generally fall when yields rise. But the good news is that going forward, returns should be better than they have been thus far this year for fixed income, although it still remains a kind of tough road ahead because interest rates will gradually grind higher throughout the remainder of the year in our view. But higher interest rates do mean that investors receive more interest, and generally investors receive more interest than they pay. And so although there is some pain up front, certainly this is a good thing. And again, this is another sign of a healthy step towards a more normalized economy than what we've seen, because 2 years ago we had the 10-year Treasury yielding 1.6%, and that's simply too low, and kind of nobody can buy that and really get any meaningful interest on it. So again, we're moving back towards a healthier environment from our perspective, from an economic basis. The last thing I wanted to talk about rather is spreads, high yield spreads specifically. And this is kind of a wonky topic here, but I think it's important in terms of gauging the sentiment of markets. And so real quick, a spread is basically, you can think of it in a very simple term. If you think about two bonds, two 5-year bonds, there's one of which is a 5-year Treasury bond that's issued by the U.S. Treasury, backed by the full faith and credit of the U.S. government. And the other one is a 5-year bond issued by a small energy firm in North Dakota. If you're an investor, you have a choice between these two bonds. Well, you're probably going to demand more in terms of compensation from that small energy firm in North Dakota than you would from the U.S. government, because there's a much bigger chance that they're not going to pay you back, right? That company could default, it could go under, they could walk away. The U.S. government is almost certainly going to pay you back, again, because that's backed by the full faith and credit of the U.S. government. So that additional compensation that investors demand over a Treasury yield is called a spread. And that could be a good gauge, because if economic conditions are great and defaults are seen to be low, and investors think defaults are going to be low going forward, investors won't demand as much of a premium over Treasuries in order to buy that lower quality bond. If times are bad and economic growth is bad, and growth rates are declining, and it looks like there's going to be more defaults of small companies, well, then investors are going to demand a lot more in terms of compensation to buy that lower rated bond. So it can be a good gauge of kind of the investors' views of kind of the future direction of the economy. And what's important to note is that right now, the spreads of high yield bonds in aggregate are very low relative to history. It makes for a lower yielding environment, but from our perspective, it's corroboration of the fact that the outlook right now is pretty good. There are certainly risks to look out for that we monitor for, but from a high level, we think that this economic expansion is continuing, not only in the U.S. but globally. We think we're picking up steam on an economic growth basis. Corporations backed by earnings growth should help propel stock markets to pretty decent gains for the full year of 2018. So thank you all very much for your time, and now I'm happy to pass it back to Tim. Thanks.
Thank you, Colin, for your thoughts on the current market environment. As a reminder, if you have any questions, please contact us. We would like to hear some feedback to help us improve the format of these calls. Our contact phone number is 781-848-9821, or please visit our website at www.leveroni.com. That's Leveroni.com. Also, if you know of anybody who would be interested in hearing our current market updates, you can forward this email to them. And once again, thank you for joining the call, and thank you for your continued confidence.